Welcome to our Back to School, Back to Basics MyWealth webinar on buying real estate cheaper in the stock market than in the property market. My name is Jeff Hunter, and I'm a Senior Investment Associate and Associate Portfolio Manager with the Townshend, Somani and Hunter Group at Canaccord Genuity. Also on the line are our Senior Investment Advisors, Dave Townshend and Raheem Somani. For more information about our team, our process, and our exclusive MyWealth global portfolios, please check out mywealthmanager.ca. Today's call is with Vision Capital. Vision Capital manage alternative investment strategies focused exclusively on publicly traded real estate securities. They are recognized as one of the few go-to names globally that specialize in this strategy and have the strong, consistent track record to support it. Today's call will be recorded, so please ensure to check your email in the coming days for access to the replay webinar. Before we get started, can you guys just give us a little bit background on who you are and where you are today?
Sure. Thank you very much, Raheem, Jeff, for opportunity to engage with your clients. So Vision is focused, as you know, as described by Jeff, in publicly traded real estate securities. So we're focused on real estate, but unlike pension funds or REITs, entrepreneurs that focus on direct property investments, we focus on publicly traded real estate securities, long and short. So our strategy is not reliant on being bulls for real estate. We seek to outperform irrespective of real estate supply and demand fundamentals or valuations. We seek where relevant and appropriate to be active investors. We don't seek to be hostile. But if we can benefit by marrying our real estate industry experience with our capital market expertise, we look to do that. Our funds have benefited from 19 takeovers in our portfolio in the last 14 years. We have flexibility within limits to invest globally. Heretofore, we primarily stick to North America because we want to be hands-on. We like to tour the real estate. It's a combination of a top-down and a bottom-up approach. Top-down for macro conditions, supply and demand, employment growth, regional economic trends, and then bottom-up for management teams, lease structure, corporate governance, alignment of interest, to establish our view of the underlying net asset value of the real estate. What is their real estate worth in the property market, and then compare it to what it is trading at in the stock market. So as Jeff introduced this segment, our goal is to buy real estate cheaper in the stock market than the property market, but if valuations are excessive or fundamentals are negative or deteriorating, whereas you can't do anything about that in the property market, you can't short an office building in Calgary, we can do something about it by being able to be short and benefit from those declining values. So, you know, a number of advantages to what we do relative to those buy property through bricks and mortar. The first I just touched on. By definition, you can't buy real estate cheaper in the property market than the property market. You know, why do we need to be the 17th guy to compete against a pension fund or REIT or an entrepreneur with too much money in his or her jeans to buy property in an auction hosted by CBRE or Colliers when we can buy real estate at 60, 70, 80 cents on the dollar in the stock market, have professional management, have corporate governance, have transparency, get geographic diversification, get property type diversification, get access to best-in-class properties that may not be available at all in the property market, even if they are. An institution or a family office might have to allocate too much of their capital to buy that one-off asset. Nobody calls us in the middle of the night to fix the heater, and we have liquidity. And well, liquidity is always important. It's years like 2020, or when Brexit came to the forefront, or September, October 2022, where liquidity takes on a different meaning. In Brexit, you had multi-billion-dollar property funds, Standard Life Assurance, Aviva Assurance, and they promised their investors liquidity on a monthly basis. And then Brexit came along and they put up gates. They said, what do you mean gates? I just read the offering memorandum and it says here I can redeem monthly. And they said, don't you know we own office buildings and shopping malls in London, England? anytime you have a mismatch between the underlying liquidity of what you're investing in and the liquidity you promise investors, are actions waiting to happen. And we had a lot of accidents in 2020, some of which are still not unwound. And in 2022, they're starting again. Those of you that read the Globe and Mail, you probably saw a headline, I think it was Monday's Globe and Mail, or Saturday, Fridays, I can't remember. And the headline was about Romspen, which is a mortgage fund, putting up redemptions. So you don't have transparency in some of these vehicles. Certainly you don't have liquidity that matches the liquidity terms. But as I said, the opposite is true. When fundamentals are negative or valuations are excessive, we can go short. You can't do that in the property market. To your question, who are we? Three senior guys, and then we'll move on. Frank Maher's background is very simple, co-founder of Vision. Frank was a top-ranked real estate research analyst for 35 years with 3 investment firms, UBS, HSBC, and Desjardins. Also served in executive in various capacities, from chairman, vice chairman, to the toughest job Frank said he ever had was the head of research. My background was 10 years in corporate real estate with Olympia New York Developments Limited, the Reichman family, with Bramalea Limited. Some of you with a few gray hairs may remember Bramalea was a $7 billion public North American-wide company. I started with Bramalea at a grad school in Chicago in 1985 in Dallas, Texas, and I was part of a team to build a 72-story office tower in downtown Dallas. And so I've done development, I've done leasing, I've done operations, I've done planning and design, I've done acquisitions, I've done dispositions, none of which we're doing at Vision today, but all of which certainly relevant to our analytical investment approach, and particularly in some of those active investing initiatives, which is particularly relevant right now. And as the real estate world went through its depression in the 1990s, I evolved into banking. I was a managing director with HSBC, where I led their global REIT practice, and then we ran investment banking and was managing partner for Desjardins. Both Frank and I have significant corporate governance experience. I've chaired public company boards, audit committees, independent special committees. I was asked by the Canadian government to participate in a parliamentary committee helping establish our tax policy in this country. And so you'll find, and you can look into it, and certainly Jeff Rahim can give you some guidance on our corporate governance. And the third and key member of our team is Andrew Moffs. Andrew is a Canadian who began his career in Wall Street with Solomon Smith Barney and the Real Estate Lodging Group. Unlike Frank and me, Andrew figured out at the beginning of his career he was more interested and well-suited to the buy side. So they helped him get a position with one of their large clients, APG. APG is the third largest pension fund in the world. It's a Dutch civil service pension fund. But more importantly to us, they're the largest investor globally in real estate securities, with $15 billion today in real estate securities investments. And Andrew is one of 5 guys managing that pool of capital. Because of their scale, they were the single largest shareholder in many, if not most, of the largest U.S. REITs. All the prominent CEOs, Sam Zell, Mort Zuckerman, would come see them. And one of those was Barry Sternlicht, the creator of Starwood Hotels. In 2004, Starwood wanted to create a real estate securities fund. They approached Andrew's boss, and Andrew and his boss, and a trader, left to be the founders of Starwood Real Estate Securities in Greenwich, Connecticut, doing exactly what we're doing here at Vision, long, short, publicly traded real estate securities. And he joined our team in 2015 and has been a great addition to our team. So, why do we exist? Number of inefficiencies. This is really a half hour on its own, so I'm not going to take much time here. But essentially, in the U.S., 80% of REITs are owned by institutional investors, where in Canada, 70% of REITs are owned by retail investors. And these institutions get benchmarked based on the performance relative to an index. The problem is, and the opportunity is, they may be overweight and underweight in index, but if it's in the index, they're going to own it. And if it's not in the index, they're not going to own it. I don't care if something is in index. Some of the biggest names, some of the smallest names, some of the best names, some of the worst names may not be in the index. If we don't like it, we're not going to be underweight. We're not going to own it, or we're going to be short. So there's a lot of groupthink, there's a lot of momentum trading. In Canada, it's driven by the fact we have 5 banks that have an oligopoly in the marketplace. This permeates inefficiencies throughout our economy, particularly in capital markets, which really justifies the existence of a group such as Canaccord Genuity. Retail investors, banks sell yield to retail investors because yield sells. This creates distortions. And so, the banks, they drive their research based on who's going to generate corporate finance fees for their firms. So there's a lot of distortions. Things get undercovered. If you don't generate corporate finance fees, you don't get coverage. And we got 100 years experience just between Frank, Andrew, and myself. We've come to know every name in the sector. We helped create the REIT structure in the 1990s. And this is certainly relevant. We don't need to rely on analysts, and we do our own work. I know if we have a number of investors, number of clients that are investors with Vision. So let me give you a quick update on the third quarter. We will be publishing our reporting letter next week, but a bit of a preview in that regard. So you're going to get 40, 50 pages of detail and explanation on the portfolio and our outlook. But in terms of looking backwards, third quarter was a solid quarter for Vision. We were almost flat for the quarter in the context of U.S. REITs being down 10%. Canadian REITs were actually down, it says 6.5%, but 7.5%. I think it's a correct number. And U.S. bonds were down 6.7%. S&P 500 down almost 5%. And so, don't feel great about it. None of us buy groceries with relative dollars, but I guess when you're beating the REIT index in the U.S. by 1,000 basis points, that was a pretty good quarter. And what we're experiencing this year, if you want to move on, Darren, is, the first 6 months of 2022 was the worst 6 months ever for U.S. REITs, ever, since creation of REITs. And what you find is in the short term, REITs act like stocks. So in the bottom chart, in the dark blue line here, there's a significant correlation between REITs and the S&P 500. But over the longer term, REITs act like real estate. And you see that both in the light blue chart in the bottom and the chart at the top, where over a longer period of time, REITs perform like real estate, as they should. But you have periods of time where REITs are above or below that long-term value. And that's precisely what occurred this year, where in periods of fast distress, rapid distress, correlations go to 1. As you saw in the third quarter, no real difference year to date. In the first 6 months, May, June, whether you had large cap tech or small cap tech or banks or bonds or Moose Pasture REIT in Saskatchewan or Brookfield Properties, everything gets painted with the same brush. Everything is not the same in real estate. And the difference between real estate in any other asset class is the private market dwarfs the public market. There is an arbitrage between the two. And this, Blackstone's figured this out. Blackstone has bought 49 REITs since their inception in the real estate space. Since between December 2021 and June 2022, Blackstone bought 5 REITs. We'd rather not compete with Blackstone. We'd rather sell to Blackstone. And we've done that on at least 3, I think 4 occasions over the last 4 years. And this is critical to understand in terms of differentiation between real estate. 1, the arbitrage, and 2, not every REIT in every geographic region is the same. And when correlations go to 1, it is not sustainable. This was a study in the Journal of Portfolio Management, an academic study, that compared the performance of private equity funds focused on real estate to the REIT index over 20 years. And at a high level, it concluded that the REIT index outperformed private equity real estate funds on average 165 basis points a year. But then they said that's not apples to apples. You've got to consider that REITs operate at 30% leverage and private equity funds operate at close to 70% leverage. Not good generally, particularly in our rising interest rate environment. You've got to consider there's no liquidity in a private equity fund focused on real estate. There's a complete liquidity in the REIT index. You've got to consider that private equity funds have to keep dry powder around for unforeseen capital expenditures or other costs. No such requirement in the REIT index. And so they concluded that only 27% of private equity funds focused on real estate outperformed the REIT index, and that's the REIT index. There's another analysis over a 20-year period, same period, that showed the differential in performance between the best performing REIT quartile and the worst performing REIT quartile. And the average differential between the best and the worst over the last 20 years was 49%. Last year, it was 80%. The first 6 months of this year, it was 15%. Correlations went to 1. Everything got treated the same. Everything is not the same. And so the question will be, what is going to change this? What has begun to change this? And before we come to that, let's talk about the environment. Everybody understands inflation. Inflation typically good for real estate. Hard asset, replacement cost values go up. It costs more to replace that real estate. Now, this is true for all real estate, but it's only going to come to fruition in terms of transactions in those sectors where supply and demand is tight. The fact that the replacement cost value of a Calgary office building went up, it costs more to build it today than it did yesterday, I don't think it's going to help the fact of values of transactions in Calgary office when you have a higher than 30% vacancy rate. But in industrial markets, in Toronto, in Montreal, Vancouver, increasingly in Calgary, in New Jersey, in Southern California, it's certainly going to have a factor. In apartments where you can mark to market your rents once or twice a year, it's certainly going to be a factor. So this is probably the biggest myth impacting REIT prices, and that's the myth of the impact of rising interest rates on REIT prices. There is zero positive correlation between rising interest rate and REIT prices since REIT started in the 1990s. And the myth is engendered by the following. The simplified value equation for real estate is value equals net operating income divided by a cap rate. All the rhetoric in the Wall Street Journal and Barron's and Globe and Mail is interest rates, cap rates, interest rates, and cap rates. Well, we can't do anything about that, but that's the denominator. People forget there's a numerator. So what we can do and what we do is focus on the numerator, because our experience, which gave rise to this zero correlation, is that 100% of the time, with a lag in public markets, supply and demand trumps interest rates. I don't care if rates are going up and down. If rates are going down and too many buildings in Calgary being built at the same time demand is reducing, value of Calgary office buildings is going down, not up. Same with things when interest rates go up. You must ask yourself, why are interest rates going up? If it is inflation, typically good for real estate. If it's a credit crisis, which we may have, it's brutal for real estate. In fact, the last major Fed tightening cycle, the Fed raised interest rates 17 times between June 04 and June 06, 400 basis points, 2 years, 17 times. Over that period of time, REITs returned 62%, stocks 16%, bonds 6%. REITs aren't bonds. They're dynamic businesses where supply and demand fundamentals matter like any other business in any other industry. So what's going to change it? The first thing is, if you want to go back, is earnings. Everything is not the same. And we began to see this in August, which helped the quarterly performance which I shared with you. When the office REITs report and another quarter of 1% declining occupancy and net effective rents down 15–20%, and leases not being renewed, that's one scenario. And when single-family rental homes report 8% increases in rents on renewals and 15–20% on turnover, that's very different. And that is the first thing. Not every REIT sector is the same. And the second thing, of course, is M&A, which we talked about to some degree. But according to Preqin, there's $364 billion of dry powder sitting with the Blackstones, Brookfields, private equity funds, fully funded, pension funds and sovereign wealth funds, They're looking to increase their weight to real estate from 5 to 10% to 15 to 20%. They can't make money in bonds. That is a very good backdrop for REITs. As long as there's a demand for real estate properties, our strategy looks pretty effective in terms of that context when you have record discounts to the underlying real estate value in public markets today. And it's interesting. We're underwriting a recession. We're underwriting an increases in cap rates, depending on the sector, between 20 and 75 basis points. That said, in those sectors where supply and demand fundamentals are tight, we haven't seen a significant increase in cap rates, because when you're take industrial, what is the relevance of a cap rate when you have gaps between in-place rents and market rents of over 50%? You have that today in Summit REIT. You have that today in Prologis and Duke. And so a cap rate is meaningless. You have to look at a discounted cash flow, an IRR rate of return, or in industrial markets where vacancy rate is 1%, Toronto, Montreal, Vancouver, rents have tripled in Toronto, and Montreal tripled. You've got to look at price per square foot and compare that transaction price to the replacement cost of building new. And so we've seen in the new financing environment, since the end of the second quarter, numerous transactions in those favorable sectors, industrial. You saw KingSett, in addition to owning a bunch of office buildings in Calgary, they bought a 1.5 million square feet portfolio of industrial real estate in the greater Toronto area, $500 million transaction, and reported to occur at a 2.5% cap rate. 2.5. Now they say, we understand that there's a 3-year weighted average term of lease rolls, and when those lease rolls, it's a 4% cap rate. Well, you can buy Granite REIT and Summit REIT and Dream Industrial REIT today between 5.5% and 6% implied cap rate. You've seen Prologis and combined with Duke, the two largest players globally in logistics in the current regime. You saw Starwood sell a $1 billion portfolio in the U.S. Sunbelt of 70-year-old apartments in the Sunbelt at a reported 3.5% cap rate. Well, you can buy BSR REIT today at a 5.4% cap rate. And so those sectors where supply and demand is fundamental, even when there is an increase in a cap rate, doesn't mean there is a decline in the property value, because with positive fundamentals, you can see increasing rents, increasing the top line, the net operating income. Let's move on. Maybe we'll move on to some of your questions, or we can tell you a little bit about our positioning today, perhaps to set the stage, as you wish.
I think one of the things that really hit the hammer on the nail was or nail on the hammer, with just the correlation and talking about the differences historically between the top sector and the bottom sector over the last 20 years, what the difference was last year and what it is this year. You know, your strategy is so flexible, and regardless of the outlook of the market, you can adapt to it. And it just seems like the discrepancies are bigger than ever, making, you know, my confidence in your strategy that much stronger.
Yeah, I mean, that's, you know, everything is not the same. So I won't be repetitive, but yeah, and you're going to see that. And to the extent that it continues, it's this arbitrage between public and private markets is particularly relevant.
Raheem, I think you had some questions as well.
Yeah, Jeff, you know, it's something you touched on, which, you know, I can't be overlooked. You know, when the Fed raises interest rates, you know, there is an apprehension, I think, from investors, or maybe the psychology or the narrative that's written out there. And, you know, the short-term window is that asset prices, you know, take a step back to absorb the information. But 17 Fed rate hikes, you know, in the early 2000s, and the outperformance of the sector, you think we're back into that sort of channel again, where the economy is generally pretty strong in a lot of sense. And we're just revising rates probably to normal in a sense. But therein lies the opportunity for valuations, I think, and where your strategy is probably prepared for the near-term volatility. Speak to, investors looking at opportunity, because, without volatility, it's really hard to grab value long-term. And this represents one of those backdrops for an investor. And it's not unlike somebody who wants to buy an investment property. They're not buying it for a return, hopefully in the next 6 weeks or 6 months, but they're really looking at 3 to 5 to 10 years. And we like investors to kind of look at sectors and capital allotment in the same sort of scenario. So if you want to paint out maybe, how the next 6, 12 to 18 months looks in a sense from where you're sitting right now.
Sure. So let me start macro, and then I'll drill down to, what we think is a proper positioning. So what we're not worried about and what we are worried about. We're not worried about rising interest rates, both for the reasons we cited, as well as the fact that the Fed could take the Fed funds rate to 4.5, 4.6. I think that's what the market is underwriting today. This is not our expertise, but that's what the market is underwriting. If that happens, and the market's saying it's going to happen, the Fed's saying right now it's going to happen, recession, maybe bad recession. And so in that context of a recessionary environment, with the Fed funds rate going to 4.5, 4.6, we don't think it's intellectually consistent, economically consistent to think that the 10-year U.S. bond is going to be materially higher than it is right now. We've had a huge move in the 10-year U.S. bond. And by the way, this is consensus view of economists. If you look out, economists are saying the 10-year U.S. bond is going to be about 3% a year from now, and it's about 3.75 right now. And so that's important for real estate. It's not the Fed funds rate per se, it's that 10-year U.S. bond. And so that's number one. We're not worried about interest rates. We're certainly not worried about inflation for the reason we've talked about. It's typically good for real estate, number one. And number two, again, we think inflation is peaked. We think the Fed is going to put gas on this fire. They're not being data dependent, and they're going to overstep. So we're not worried about inflation. What we are worried about, we said supply and demand. We're worried about a recession and the demand side for real estate, number one. And we're worried about the prospect of a credit crunch, which ain't good for anything, including real estate, a credit crisis. So we already see, if you're not a top 10 lender of a bank, you're going to have a hard time getting your mortgage money. But if you see markets freeze up and a freeze up of credit, these are the things we're concerned about. And as Darren put up on the slide here, even if you don't agree with me, the facts are, this is not 1990. When I worked at Bramley, and Bramley was no different than Cadillac Fairview or Ontario, Teachers or Trammell Crow or Cambridge or Compo, they operated maybe 1.1 times interest coverage ratios. The transformation of real estate generally to pension funds and REIT ownership have resulted in much more conservative balance sheet. Today, interest expense as a percentage of net operating income is less than 20%. Coverage ratios are 6 to 1. The weighted average fixed rate debt is over 7 years. In Canada, coverage ratio is about 3.5. So we're not going to have balance sheet crisis in real estate in a declining environment. Let's talk to you about our views of how one should be positioned and the crux of your question. So I mentioned earlier single-family rental homes. These are homes in the Sun Belt that you rent. They're between, say, 1,200 and 2,000 square feet. They rent between $1,300 and $2,200 a month rent. Lower rent per square foot than an apartment. you get a backyard, you get a driveway. It's typically families that choose to locate there based on a local school district. Now, those were factors in place before the pandemic, but this sector is getting a boost from the pandemic. You mean I can move there and away from common areas and elevators, have a place in the back of the house to homeschool my kids or work from home on a longer term basis and pay lower rent per square foot? I'm in. And so this sector, it also benefits from no meaningful new supply. There's no real supply of homes that are built purpose for rental. That started to happen, but it's de minimis. And, you know, this sector may actually be a beneficiary of a recessionary environment where we have the affordability of homes have cut in half. It costs you twice as much in terms of your carry costs with it rising interest rates to buy a house. You got to live somewhere. So this is a sector that we think should do well and has done well and continues to do well. Got beaten up this year, completely crushed. Industrial real estate. Everybody gets this now. It's old news. Three powerful demand drivers. First, again, everybody understands e-commerce. Spiked to 25% of total retail sales in March 2020. It's come off to 19%. We think by 2025, it's back to 25% or higher. Jeff, you said recession. I did say recession. So Walmart sales are going to come off. But Walmart will still need that distribution space to service the sales they have, an increasing amount because of e-commerce. In fact, last week they announced $1 billion investment in Quebec and Eastern Canada for precisely that. Number two, reshoring. The return of manufacturing to North America. This is powerful. These are 50-year decisions. Canada couldn't rely on the United States with Donald Trump blocked their masks from 3M Corp at the border in April 2020. In Walgreens and Duane Reade in New York City in August 2020, there was a shortage of Tylenol. I don't think any of us want to rely on China for pharmaceuticals or semiconductors. And you've probably heard the announcements, 2 multi-billion-dollar chip plants announced for Austin, Texas. Intel investing $100 billion outside Columbus, Ohio, with Brookfield is financing $30 billion of it. You've seen Foxconn, an assembler. You've seen Taiwan Semiconductor. You've seen Qualcomm, all announce significant new facilities in North America. This is powerful, and we don't think it's going to be inefficient like it's been for 60 years. It's going to benefit from automation, robotics, and artificial intelligence. Economists believe 20% of all U.S. imports from China will become manufactured onshore United States. That's a big number. And number three, you know, I was in business school in the 80s. The major operations class focused on the Japanese concept of just-in-time supply chain. Just-in-time supply chain is done. It's over. It's history. Now it's just in case. Inventory management. Nike will still make their shoes in Vietnam or Cambodia or China, but Nike will carry additional inventories in Western economies. These three factors are powerful. On the demand side, we watch supply. Easy to build this stuff. Still easy to build it. Not so easy to build it. Get the land in Toronto, Montreal, New Jersey, Southern California, Vancouver, where these users want to be. Development charges, construction costs, supply chain issues. And so supply has been muted. We see really South Dallas, Indianapolis, Phoenix, Central PA is the only pockets where some increased supply. Today, as I mentioned earlier, gaps of 50% between in-place rents and market rents in industrial. This cash flow will be significant. Necessity-based retail. I mentioned active investing earlier. You know, one name in particular, a good name for you and your clients, is First Capital REIT. First Capital REIT is the finest grocery store and pharmacy-anchored shopping center REIT real estate entity, period. I think globally, certainly in Canada, I think no doubt in North America. You know, think of Loblaws, Safeway, Metro, Shoppers Drug Mart, Canadian Tire anchored shopping centers, necessity-based real estate. Well, they're the finest portfolio of real estate, and they were an outperformer for many years. The last 5 years, It's been the worst performer in the shopping center space in Canada, where the average of the comps have generated a 35% return over 5 years leading to the recent annual meeting. First Capital was down 13%. That's a 50% differential. It's public information that the former CEO, co-founder, and former chairman, Mr. Dory Siegel, showed up at the annual meeting, asked 2 pointed questions to let the world know that he's gone hostile on this. And I expect that corporate action, in our view, is appropriate when you have this disconnect for many years. Manufactured housing communities, the single best real estate asset class for 40 years. Some of you out west may remember Parkbridge, great investment bought by BC Pension Fund. Well, institutions didn't get it for 25 years. They got it for the last 15. It's the most pure form of cash flow in the real estate space. You go and you spend $250,000 to buy a prefabricated manufactured home, and you put it on their land. They charge you land rent. You pay the realty taxes. You pay the operating expenses. So it's the most pure form of cash flow there is. As a result, it is traded at a significant premium to net asset value most of the last 15 years. So we didn't own it. It wasn't a name provision. We like to buy at a discount, not a premium. Well, January 2022, June 2022, August 2022, we're buying into this sector at a discount to net asset value. This sector has never ever had 12 months of declining net operating income. Affordable housing. And niche apartments. We're concerned about apartments globally. A lot of populist governments looking at, frankly, at an admirable goal, which is humanity should have an affordable place to live. But the answer that they're coming up with is draconian in terms of rent controls that exacerbate, not solve the problem. And so our investments really are two significant investments in North America. One is Boardwalk, based in Calgary. 55% of Boardwalk's net operating income is in Alberta. And BSR REIT, 90% of their net operating income is the state of Texas. Alberta and Texas are the two last places on the planet I think you're going to see rent controls. Your government, as you're probably aware, has been spending money. Every time I turn on the radio here in Toronto, there's a commercial saying, Torontonians, the average price of a house in Toronto is $1.4 million. It's $700,000 in Calgary. Lifestyle, quality of life. This is working. The population migration to Alberta is solid. Things you tell me, but they look pretty good out there. And so that's our positioning in Alberta right now. We're negative on office. We've been negative for office pretty much forever. I've never seen anybody in history make money with a buy and hold strategy in office. Very difficult to do. You can buy it 80% occupied, lease it up to 95%, sell it, make decent money. But to sit there year after year at 95% occupancy and think you can get a reasonable return, difficult to do because the capital expenditures kill you. And it's not the lobby renovation or the mechanical room or the parking garage, it's the tenants. Every time you need to lease that space, you've got to give free rent and tenant improvement in dollars. So from 2000 to 2020, we already had a 20-year secular decline in demand. What do I mean? The lawyers don't have law libraries anymore. Deloitte built new buildings in Toronto and Montreal. They went from 300 square feet per employee to 160 square feet per employee. No offices for partners. That was already happening before March 2020. Now, when you've had the CEOs of HSBC, Meta, Shopify, Target stores, Bank of Montreal, et cetera, come out and say publicly their workforce has worked really well in a remote work from home hybrid environment, their long-term demand for office space is going to be lower. We believe them. We see a 15% long-term reduction in demand for office space as a result of the catalysts from offices and debt. It's just demand side is tough, and this is in the context of over 100 million square feet of new supply being built We think rents are going to be down at least 15% from this factor. So this gives you a sense of how, to your question, how you can make some money if you're positioned in the right sectors and the right geographic regions, as opposed to more challenged sectors with fundamentals. Maybe I'll pause and open it up to questions that you might have.
That's great. So we got the value proposition. Just two quick questions. One, hedging. Additional sorts of thoughts very quickly on hedging and how you protect the portfolio and the investors. And
sure.
you as an investor and your team and the firm aligned with all of Vision's investors, and how you guys go about ensuring that your capital is as same as the investors.
Yeah, they're kind of blended questions because they're both related to risk. So you take out my personal residence, the majority of my net worth is in the fund. There's about $30 million of investment from the senior portfolio management team. None of us came from high net worth families, and trust me, it makes a difference. We don't seek to be the best performing fund in North America. We'd like to be the very best risk adjusted performing fund. And you see that in some of the risk metrics that your team, Rahim, are experts in explaining to folks in things like Sharpe Sortino ratios, up market, down market capture ratios. But some of the hedging or risk management approaches we do, first of all, it's essence to our strategy. When you're buying real estate at 60, 78 cents on the dollar, there's some defensiveness right there. One of my former clients, he was in Atlantic Canada, Newfoundland, actually, so pardon the twang. He used to say, it's hard to follow the bed when you're sleeping on the floor by. When you're buying real estate at 60, 70, 80 cents on the dollar, and then market's correct. Okay, so now it's 70, 80, 90 cents on the dollar. There's some cushion inherent by buying at a discount. Number two, you can be short. So that, and we don't use most of our shorts are part of long, short paired trades. Where in evaluating the performance of that trade, you look at both sides. And so I remember we had the same trade on a number of years ago, familiar with the names. We were long H&R REIT and we were short CREIT. One time they both went up in price. We made money because the long went up more than the short went up. One time we made money when they both went down in price because the long went down less than the short went down. One time was a perfect world where the long went up and the short went down. Now, we could have lost money if the long went down and the short went up. That hasn't happened once in 15 years, and so that's a metric. Number three, we hedge currencies. We're not currency experts, so there's no gains or losses in our returns from currency. Number four, we don't use any long side leverage. We do not buy stocks on margin. If you want to add debt to leverage it, your clients can add debt. We don't need to do that for them. So we don't enhance losses or gains by using leverage. I think the diversity of the experience of our team is another factor that adds to it. We have three senior guys. As Darren said, we've only done one thing our entire careers. We're not stock jockeys that came to real estate. I bring real estate background. I bring in, investment banking, corporate finance, balance sheet. Andrew is a career buy-side guy. Frank is a top-rank analyst. The melding, and we like each other. We respect each other. We don't always agree. Trust me, that's helpful to managing our portfolio, and we break arguments based on, we break disagreements based on rational thought and analysis, not opinions. I think our board is a key part of risk management. We didn't run through it, but very briefly, what's important about these guys, besides who they are and what they've done, is number one, to your question about alignment, they're all large investors in the fund. And as a result of that, they're very active. These are not, pretty names in a pitch book. Ira Gluskin is on our board, the founder and chief investment officer of Gluskin Sheff, probably the closest thing we ever had to Warren Buffett in this country. But people don't know about Ira is before he founded Gluskin Sheff as the largest carriage trade asset manager in Canada. He was a real estate research analyst, so he's particularly knowledgeable in our space. Richard Nesbitt, who was Frank Marin, my boss when he was CEO of HSBC, was then president of the Toronto Stock Exchange, was recruited to be chairman and CEO of CIBC World Markets, took early retirement, moved to London. He's a professor at London School of Economics. Dino Chiesa was an 8-year chair of Canada Mortgage and Housing Corp, CMHC, significant government, private sector, nonprofit experience, currently chair and trustee of 2 large North American REITs. Gary Goodman was Paul Reichman's right-hand man for 30 years. Mr. Reichman was my largest client for 20 years, so Gary got to know as well through that process. And Patricia Saputo. Patricia runs the family office for Saputo Inc., her family. But more importantly to us, she's the chair of Concordia University Pension Plan Board and chairs their investment committee. Vision presented to that investment committee in December 2012. They invested in December 2013. Most of the last 8 years until JP Morgan showed up last year, and we were approved as the exclusive REIT alternative fund for JP Morgan's global high net worth platform. Concordia has been our largest investor. Patricia is a governance hawk, a tax guru, and so these folks are very hands-on, and they add to that risk management framework that you're inquiring about.
Great overview. Jeff?
I think I've got to say thank you very much for your time. Your insight is always welcomed, and your expertise is next to none. And for those listening, we'll send you the replay out shortly once approved by compliance. But again, Jeff, Darren, Chase, Brett, thanks for your time today. Our clients really appreciate it, and so do we.
Likewise. Any follow-up questions from you and your clients, you know where to find us.
Perfect. Awesome.
Thanks, guys.
All right. Have a good afternoon. Thanks.